All right, so what's going on? I mean, the shilling looking a lot better than it's done over the last few weeks. Obviously, the central banks intervened. They've raised the overnight rate. What else is at play?
I think basically that's the main factor. What CBK did, they didn't come and intervene directly in the market. They cut off the avenue that the speculators, as the CBK alleges, were using for arbitrage, which is the overnight discount window. They pushed up the rate to about 8%. Although it's not quite clear now what happens to the CBR, because the overnight rate has always been, for the last few months, has been pegged against the CBR. But now the overnight is up. CBR is still at 6.25. Right. The MPC is not meeting until August, although there were rumors that the CBR might be pushed up in this first week. So basically, it's all mostly you'd say it's psychological, and also that a cheap funding has been cut off. So basically we did see the shilling strengthening, but also the fact that end month corporate demand is a bit over. It's the beginning of the month. Corporate demand is not so heavy, so we'll see the way the month progresses.
All right, what's going to happen to loan rates in general? Because the CBK is really worried that with the raising of interbank rates, overnight rates and interest rates in general, it's going to be passed on to consumers who are already stretched.
Okay, of course, there is, a big possibility that lending rates will rise, commercial lending rates. We've already seen two local commercial banks raise their base rate by around 2%, to an average of about 1.5%. So I think that's one of the reasons why CBK chose to leave out the CBR when they pushed up the overnight rate, so as not to send the wrong signal to the market. But I think at the end of the day, the rate that matters more to the commercial banks is the discount window rate more than the CBR. What gave the CBR relevance mostly was the overnight lending rate.
All right, let's talk about the equity side of things, because that's really where the market has been really under pressure and subdued. The threats of inflation continuing to put pressure on stocks, growth also not particularly buoyant. But we are seeing, for instance, Total up, the share price increasing 7.6%. And it's ironic because it comes at a time where regulators are talking about petrol price caps.
That's actually true, but also it's based on the fact that look what's happening with Kenyan Market. They announced that we should expect really good first half results. Same thing, investors are looking at Total the same way. They're both in the same market, although Kenyan Market has a bigger market share. They're both in the same market, selling to the same public at basically the same prices. So what I think investors are pegging this on is that over the last let's say throughout most of the first half of the year, the petrol companies have made quite a lot of money.
All right, we've been talking about banks, and as Mashudu showed you, KCB is still a relatively good performer in the market, although their PE ratios are very, very high. Foreigners tend to like the stock.
KCB is always it's always looked at as a growth stock. It's also in a way a defensive stock. It doesn't, it's not a very volatile stock. It doesn't move much. It always oscillates between levels of about 20 and at the very most 25, 26. So it's always a very reliable stock and a good growth stock. I mean, the prospects for KCB are pretty good compared to the rest of the banking sector.
What about the insurers? Because the one phenomenon we've seen is as people have held back on banking stocks, they've been pouring into insurance stocks. For the longest time, Pan-African's been doing really well. CFC, for instance, coming through. And we know IPOs coming in from private equity companies and investment houses. So financial services in general doing well, but why the insurers in particular?
I wouldn't actually put it that the insurance counters are doing that well. Mostly I just peg it to speculators. But of course, the insurance industry, the outlook on the insurance industry is quite big. I mean, they've grown in leaps and bounds over the last 5 years. So on a long-term view, the insurance companies are a good buy. But basically, and then of course, there's an IPO coming up. We're not quite sure how it will perform. Although the public do look quite enthusiastic. They're hoping for another repeat of what happened with the Equity Bank IPO. So, but I think at the moment, in the short term, mostly insurance companies are being driven by speculators.
All right, Standard Group is also up today, 2.16%. No surprise, really, for those who've been looking for safe havens. The media stocks, the advertisers and the services companies are the ones that they've been looking to.
That's quite true. Of course, when the market is the way it is at the moment, most investors will move towards defensive stocks, and most of those are the blue chip counters, the Standard Charters, the Nation Media Groups, so on and so forth.
All right, Everready is up 2.5%. Now, we know that their earnings over the last few years have not been particularly encouraging. They've suffered huge losses in general with the influx of cheap products coming in from Asia. The manufacturing costs have increased. And we've even heard rumors, and these are rumors I underscore, that they might want to move their operations outside of Kenya because the cost of doing business are rising. What's working in their favor in today's session?
Basically, with Everready, I'd call it's a penny stock. I mean, our local penny stock. It's a stock that's really cheap. I mean, moves a few shillings. So you see a lot of retail investors coming in, taking positions, hoping for it to move a couple of cents. They exit. It's not really backed by any firm fundamentals.
Okay, going forward, and finally, Kenneth, bonds could be where people go as interest rates rise, but there's still the threat of inflation and a volatile currency. Equities, the market subdued, but could rise with more IPOs coming to the fore. Where should investors be putting their money?
Basically, what we've been seeing with investors, especially over the last quarter, has a lot of them have been running to treasury bills, which which were offering pretty good levels, at levels of about 9%. Although they've started declining, but marginally. I mean, levels of 9% over 3 months was a pretty good return. So we saw a lot of investors running towards those. As we go forward, I think the interest rates in the bond market will stay stable. They actually will not decline or have any steep inclines. And actually, even the MLF, the Market Leaders Forum, are meeting tomorrow to discuss this month's bond issue. Most of the market expects a 15-year paper, which should correct the distortion that's currently in the curve on the 15-year tenor.